In this video, I'll explain in a couple of minutes what the common misconceptions are for Brits that have pensions and they remit into Thailand. What are the common misconceptions with the double taxation agreements and being taxed in the UK at source, and what they have to do in Thailand? So today we'll talk through some of the common misconceptions from UK pensions specifically. So what the common problem what we see is people state, well, I've already paid tax in the UK at source on this pension, and there's a double taxation agreement, so it means I don't have to do anything. Well, that's not correct. If you are a Thai tax resident, so that means you have stayed in Thailand 180 days or more in a calendar year. If you bring in foreign source income like a UK pension, so private pension, final salary pension, a SIPP, or UK state pension. If you bring that into Thailand and you're over the minimum threshold to file, which is quite low. So if you're married and your spouse doesn't have an income, you can file jointly and you can bring in up to 220,000 Thai baht per year from these sources. And if you're single, you file in on by yourself. And if you're single or your spouse has an income already in Thailand, then you can only bring in 120,000 Thai baht per year before you have to file a Thai tax return. So let's assume that you do bring in more than the minimum threshold per year from your pension from the UK. A lot of people state, well, I don't really have tax to pay, or I've paid a lot of tax in the UK, so I don't need to do anything. Well, that's not the case. The Thai UK Double Taxation Agreement states that Thailand may tax pension income in Thailand. So what does that mean? It means you have to file the income on the Thai tax return. And then if you've paid tax in the UK, you could potentially use the tax paid as a tax credit to offset the tax. But you still have to get a tax ID number and you still have to file a tax return. And on visa renewal, it's quite likely that you'll be asked for a tax certificate or proof why you don't need to file a Thai tax return. So it's very important. Even if you've paid tax in the UK, the double taxation agreement just means that you don't have to pay tax twice. It doesn't mean you don't have to file a tax return. So for an income that you bring in from the UK, whether that's a state pension or any other type of pension, whether that's private pension or final salary, you have to file that on a Thai tax return. You have to file that. So in the calendar year, the Thai year is different to the UK tax year. So it's from the 1st of January to the 31st of December. That's the tax year. If you're there 180 days or more, then you bring in, we call it remit, the foreign source income, so pension income from the UK, you need to file a Thai tax return from the 1st of January all the way up until the 8th of April if you file online for the previous tax year. So you'll need to obtain a TIN, tax ID number. You can obtain that from your local revenue department, or you could use a paid service like Expat Tax Thailand provide, where we can obtain that on your behalf, fully remote. And then you will need to file a Thai tax return. You've got a few options. Again, you can visit your local revenue department and fill out the paper forms, or you could use the online system from rd.co.th, or you could use a paid service like Expat Tax Thailand, where we have a client portal. Very simple to fill out your details. We help you through the process, guide you to what forms and documents are required in order to claim the maximum allowances and deductions for your situation. We take the stress away from having to file. If you would like more information, feel free to visit expattaxthailand.com. You can have a free consultation, or click direct to sign up and fill out your details for our filing services.